Well, brace for impact. It looks like we're going to get a hard landing. We've been talking about getting a hard landing. Even the Federal Reserve is starting to say we're going to have a hard landing. Let's go to my very first slide. Let's just talk about what we see. Now, here it is. The Federal Reserve's own economists are saying that, hey, look we've tightened pretty quickly. It's going to have an effect on investments. It's going to have an effect on those companies that are over leveraged, maybe the startups, the ones that have really been using capital to pay the bills. They have no revenue, certainly have no cash flow. Those guys are in deep trouble. And you think that's going to have some trouble? It's going to have an effect on investments? Well, their own economists are saying the number of over-leveraged firms, what a surprise that is in distress. Over-leveraged firms in distress is likely to have effect on investment, employment, and aggregate activity that are stronger than the most tightening episodes since the 1970s. So it looks like we're following in the footsteps of Paul Volcker. Now, I was there in the 80s when this happened. It was awful. It was pervasive. It felt like it would never end. And it just brought things to a standstill. Bethlehem Steel went out of business. Republic Steel went out of business. I think I was living as a young guy in Chicago. I think we had like 60,000 journeyman electricians out of work. Certainly, steel mill workers were out, and it affected everybody. It affected auto sales, auto manufacturing. It affected retail. It affected services. It affected absolutely everything. And the Federal Reserve's own economists are saying it's likely to have effects similar to the late 1970s. Well, that was kind of like Volcker. And who is a big fan of Paul Volcker? Jerry Powell. He thinks he's an American hero, and he's in charge. Let me go to my next slide. So here's a recipe for a hard landing. So now we have historic Fed tightening. Never had it go this fast before. Haven't had it go so quickly and at such a pace. And we're just now starting to feel the effects. Keep in mind, it's such a lag. You hear about these lag effects. We're talking 9 to 15 months, and we are just beginning to feel the effects of the first tightening. This is just happening now. This is something that we're feeling. Now, you got sticky inflation. Now, when you're my age and we got like a 9% Social Security increase, we're not going to give that back. You can't imagine that the people working at Starbucks that got like a $3 and $4 or $5 an hour raise, they're going to give that back. No one's going to give that back. Once you start paying $5 for a gallon of gas, when you pay $3.50, you think, well, that's a great deal, but it's nowhere near what you're paying before. We were paying $2, $2.50, certainly under $3. Now, if you get like $3, you feel like you're getting a great deal. That's sticky inflation. And the banks are in trouble. Banks are in major trouble. We just lost 3 here in the United States, and we lost Credit Suisse. And the Federal Reserve had to come to their rescue with $100 billion, and that's why we got a pop. They put almost $400 billion into the economy in 1 week. 1 week. So where do you suppose that money goes? Well, that's helping my industry out. We got housing sales have been a little better. They're starting to slow down. It's only good for so long. $400 billion sounds like a lot of money, but globally it's just a drop in a bucket. And because that we're losing this liquidity, banks are tightening. And the banks aren't paying as much as you can get in a treasury bill. You get a treasury bill for 30, 60, 90 days, 5%-ish. Probably can't get that in a savings account. Certainly can't get it in CDs. If you get a CD, you've got to pay a penalty if you want to do it early, unlike going into a treasury bill. So the banks are losing reserves. They're losing their deposits. Their M2 is dropping like a rock. M2 is credit, and that's in the checking accounts and the savings accounts. So you have banks tightening. If you had $1 billion, you didn't feel so bad. If you only have $100 million, now you want to be careful who you lend that money to. That's called tightening. That's when the underwriters start thinking, well, we're going to start raising your credit scores. And we're seeing that in my industry. We're seeing credit scores going up for approval. And we're seeing the marginal buyer, who is at the beginning of the chain, they're getting, again, priced out of the market. And they're getting out of the market because the underwriting standards are getting tighter. So let me go to my next slide. So here's what we're talking about. Now, we talked about this. I've used this slide before, that the producer price index is starting to come down. So I do think that we're going to have inflation come down. And there's no pricing power for these guys because there's the demand destruction is fully in operation here. And you can see that as the M2, that's the money supply, that's mostly checking accounts and savings accounts, drops, PPI follows it right along with it. And I just got that basically this morning. I did get this morning from Zero Hedge. Now, manufacturing, the United States is still a big manufacturing. People talk about how we don't make anything. That's just not true. We make a lot of nice things here. And manufacturing here is falling off. Now, we just got this PMI, and the PMI is in 46. Now, if you're 50 is the line. It's the line in the sand. So if you're over 50, the economy is expanding. Everything's looking rosy. Now it's under 50, and it's not just like close to 50. It's in the mid 40s. It's at 46 and heading south. That means that manufacturing is in trouble. And of course, that when manufacturing gets in trouble, manufacturing is one of the canaries in the coal mine. Now, when you start talking about PMI output index, we're seeing that there's no pricing power. There isn't any pricing power, as we talked about before. Manufacturing's falling off the rock. They want to get all the business they possibly can. When your business is slowing down, that's not when you start getting aggressive on your pricing. And some of the words that we're hearing from the manufacturing when they do their Institute of Supply Management, they do the comments. This is the darkening picture was severe drop in demand for goods, a severe drop with new orders slumping at a rate among the steepest since the global financial crisis of 2009. That's not good. That means that the demand for our manufacturing goods is dropping at a rapid rate, mimicking past recessions. Let me go to my next slide. Let's take a look at that. Now, when we talk about my business, this guy is one of the pillars of our community, Robert Schiller, Dr. Robert Schiller. He, of course, is the advisor to Case-Shiller Home Index. He was recently interviewed. I've used this slide before. He says that homes are very, very high by historical standards. And if you can delay your purchase, it might be a good time to do so, because he thinks that prices are going to continue down. Now, we've been on a moratorium for new capital since early last year, March and April of last year. That means we're not putting any new capital in. We're still doing lots of business, but we're not putting new capital in. And I'll expound on that in a little bit. Now, further to compound the problem, we've got a inverted yield curve that we haven't seen since the 80s. Since Paul Volcker was in Federal Reserve chairman, and who, of course, thinks that Paul Volcker is an American hero. I've mentioned this before. Jerry Powell thinks he is. And we've got over 100 basis inversion. Now, we haven't had that since the 80s. Even through the great financial crisis in 2008, we didn't invert this much. So I think when you start seeing this inversion like this, it's just going to really put the brakes on the economy. And when it puts the brakes on the economy, it causes a momentum to the downside. So I think that this has got the potential for being very, very steep and very, very deep, and I think long. I think this can be a pretty tough recession. In the 80s, they did not they let up, and that caused the inflation to come back, and they just had to really just stomp on the brakes again and just break the economy, because recession 100% of the time will kill inflation. And here's what we talked about this, is that the home prices, when you start looking at price to median income ratio, it's the highest we've ever had, the highest. So how do you expect to have a robust housing industry? How do you expect the builders to do really well? How do you expect the realtors to do really well? How do you expect the lenders and appraisers and home inspectors and the people who are dependent upon home sales for draperies and blinds and furniture, when we've got the highest income ratio ever? That means that it's going to really slow down housing. It's just, what else is going to happen? It's the greatest in history. It's the greatest ever, and ever is a very, very long time. I got this a couple days ago. We're talking about pending home sales. It's been a very, very interesting picture, because, as we've mentioned before, builders do want to get rid of their inventory. These builders built homes, and we had such supply chain problems that instead of taking 90 to 120 days to build a house, it took a year and a half. Well, so much happened in a year and a half. People were waiting a year and a half to buy a house. Well, interest rates, it's just, we all know what happened. Interest rates went from 3 to now they're looking at 6.5%, 7.5%, and they can't afford the house that they originally bought. And the builders have built it for them. They're not in the business of spec building, and they're very aggressive. They're giving incentives. They're doing, anything they possibly do, buy downs, doing anything they possibly can, because they don't want these houses. They built them for a buyer. They didn't build them for a spec. So consequently, we saw builder sales pop up. But now we're looking at existing homes pending sales, and they're down. They've been down for a while. I actually think this is we're forming the second peak here. But we just got June. I mean, literally just the first of the month, we got June sales. They are down 2.7%, and year over year they're down almost 21%. And that's pending home sales. That's existing. That's the real world, guys. And home sales are coming down. As I mentioned before, what happens? What kills inflation? Well, we got PPI heading to zero, and that final demand is just dropping off. It's actually going negative. And you know what kills inflation? A good recession does. And a recession is going to kill it 100% of the time. So if you've got sticky inflation like we have now, a good strong recession like what I think we're heading to is going to kill that inflation. And it always looks like it's a soft landing because it starts slowly and then happens all at once. So I think we have a controlled demolition of the economy underway right now. And what do you suppose is going to happen? So we're starting to see signs that employment is starting to slip. Less hours. We're starting to see that credit cards have gone up into the mid-20s. 20% return on credit cards. Well, I'm going to tell you, if you've got any kind of balance on it, well, this is going to cause you to quit spending. So this is going to be a spiraling down economy. So what is going to happen to people? Start losing jobs. They don't get as much time. Some of their investments maybe start to slow down. They talk about the elites, but if stock market is at risk, people quit spending. So what are they going to be forced to do? Well, we think we're right at the top of our cycle. We think that we're actually forming the final peak, and we're telling people to wait. Unless you absolutely positively need to buy a property, or you're getting such an incredible buy on it that you think, well, how can I pass this up? Because we still are doing business, but we do think we're at the top of the cycle. I think we're heading into a completion of the cycle, and I think better pricing is certainly coming. We haven't been, as I mentioned before, we're not putting any new liquidity or any of our new capital into the marketplace. We're actually saving it. We're sitting on a ton of capital. We're just waiting for an opportunity to enter the marketplace. We're just waiting for an entry point. And what happens when we get to this top? It rolls over, and when it rolls over, we start seeing pricing start to decline. Because when you start pricing people out of the market, if you've got $1 million house and it's at 3%, well, a whole lot more people can afford it at 3%. We start going to 7 or 7.5%. This is really a problem. So what has to give? People can only afford so much. So that house is probably going to lose value. That has been the case in all the prior other cycles that have rolled over. I'm going to tell you, here in Arizona, we're starting to see some of our mountain homes and the cabins in the mountains start to, prices are starting to soften up a little bit. And who can afford to spend $50,000, $60,000, $70,000 a year for a weekend home? Very, very few people. Obviously, there are some people can, but the vast majority of people cannot. And a lot of these properties are coming on the market. And I expect that we're going to start seeing a lot of very, very good bargains in the mountains soon, and at the lakes and around anywhere where it's discretionary. But what looks like a bargain now might not be way too high if we just wait 12 months, 18 months from now, because I think that prices are going to continue down. Now, I want to get serious here for a moment. We've been talking about our endangered cities, and these cities are certainly endangered. Just look what's going on in Philadelphia and Chicago, Los Angeles, San Francisco is already underway in Chicago, in San Francisco. So if you have investments anywhere near these cities, you have to start thinking to myself, what is this going to look like in 5 years? Because I'm going to tell you, when you get a cycle completion, by the time all the excesses get wrung out, all the people who are going to default that shouldn't have bought a property, that got overexcited, over leveraged, it takes 3 to 4 to 5 years before that happens. So you need to make a decision. If you're going to keep the property, you're going to have to keep it for 4 or 5 years. So what is Chicago going to look like in 4 or 5 years, or Minneapolis, or Portland, or San Francisco, or maybe Los Angeles? You need to talk to your broker, talk to your financial advisor, talk to your CPA, and start thinking if this is where I want to keep my investable dollars. And if, of course, a lot of do this equation is that I've got $500,000 to $1 million to $2 million to $5 million of capital gains, and I don't want to pay tax on them. Well, then you should do the IRC 1031 exchange, and you don't get a taxable event. It's very, very inexpensive. We highly recommend that you do this. You can move from an endangered city, get yourself into Florida, Texas, or Arizona. You can get into Plano, Texas, or Miami, or you can get over to Pensacola or Tampa. You can get over to places in Arizona here. Certainly come here to Phoenix, where we have absolutely outstanding growth prospects for decades. So now I expect we're going to have a downturn in housing in these better markets of Florida, Texas, and Arizona. It will be a correction in an ongoing bull market. Now, it could be a fairly severe correction, but as we've talked about before, these are regional. So when you have a region that's at risk, you're going to get a much steeper decline than elsewhere. I highly recommend that you start thinking IRC 1031 exchange. Let's move your investable dollars into a better market while you still can, while it's still viable. We're here to help you any way we possibly can. We've done hundreds of them. It's really easy to do. You're welcome. This is where you can reach me. I'm really available. So if you need me, please give me a call. We'd love to sit and chat with you. We'll brainstorm with you and your advisors. Try and make a plan that's going to work for you. Have a happy 4th of July. My very, very best to you. Bye-bye now.